Manish Sonthalia joins us now, Senior Vice President and Head of Portfolio Management Service with Motilal Oswal. Manish, good morning. Manish, thoda has do. So what, mid-caps are down right now. Everything is not gloom and doom.
Yeah, so first we had this reclassification of the large cap, mid cap, and small cap, and now there's margin funding liquidation happening, or margin calls getting triggered due to additional surveillance mechanism and graded surveillance mechanism, so on and so forth. So I would believe that most of the numbers in the mid cap space are fair. For the fourth quarter, it is this liquidation which is taking down the entire mid cap and the small cap down. There is deep value which is emerging in the mid cap and the small cap space, because these are technical factors, and earnings growth is only the truth that markets will ultimately follow. So I would believe that there are excesses created on the downside as far as the mid and the small cap is concerned, and anybody who has money at these levels and could wait for some time, these are very good times to buy into mid and small caps.
So what has been your portfolio approach in this hour? You told me, I think in 2017, that there is a froth in mid and small cap stocks. You got it right, but only after 1 year, and now some of the mid and small cap stocks are getting smoked. Are you a buyer in small and mid cap stocks?
No, so just to give you some numbers, we did some analysis. 60-70% of mid cap stocks are down more than 20%. So of course there was froth in the mid and the small caps in 2017. These checks and balances should have been taken at that point in time. Now we are approaching levels which are way below fundamentals. So my sense is, if the outlook remains strong, and let's say the PE valuations have literally halved for most of the mid cap names, it would be classified as deep value. So that is how I would look at the entire space currently. I would believe there is more money to be made in the mid and small cap stocks if somebody puts in money at this given point in time, as opposed to the large caps, which are again seeing excesses created because of money rotating away from mid and small caps into large caps.
So what are you buying or selling in this mid cap?
Talking about my portfolio.
No, I'm just curious to know that, because if you feel that there is opportunity in the mid and the small cap stocks, what has been your portfolio strategy? Where are you picking your spots? Has anything changed in the way you are approaching the market, let's say in Jan 2018 versus how you're approaching the market in June 2018?
No, so we have full allocation and full deployment of all the corpuses that we have. Any incremental money which is coming, previously we used to have some maximum buying price for stocks when the froth was there, and we didn't used to buy some of the stocks which we liked, but the maximum buying price on those stocks was exceeding the price that we saw on the screen. But that portion of allocation was remaining in cash. A lot of that has already got deployed, so we are getting what we wanted to buy at lower levels, and that would have suited our purpose. So we have deployed that corpus. The portfolio construct remains the same. We want to buy a few additional names in our mid and the small caps, but there's liquidity issues out there, because the quantum that you want to buy, even that is not available even in a falling market. So the surprising part is that we are seeing the prices actually fall precipitously, but if you go out to buy decent quantities, you don't get your required quantities on the stock. So I don't know what sort of a market, because it seems to indicate that things are just falling like 9 pence, but any decent buying can equally lift the markets significantly higher from, because it's a very shallow market. Prices are falling on very thin volumes and so on and so forth. So I think this is a lot to do with forced liquidation without much of a volume. So we are looking out to buy whatever we want to buy at these levels, provided we get the required quantity that we want to buy.
Okay, Manish, now that the earnings season is pretty much wrapped up, we have a month of transition before Q1 numbers start trickling in. What is this channel checks indicating to you about how the year has started off from an earnings standpoint?
So we have a very positive base effect of last year as we come into 2019 first quarter. So the current quarter numbers are going to be very good for the usual sectors per se. So whether it be the consumption, and within that the staples are likely to do much better than let's say discretionary, or whether it be the private sector banks and so on and so forth. So I think what is notable is from the fourth quarter numbers was that we saw this transition happening from 28% to 18% on the GST rates, and we saw actually volume uptick in many of the consumption names. Now one could argue that whether that was due to a shift from unorganized to organized, or whether that was price elasticity of demand kicking in because GST rates have actually come down. So I would believe that the unorganized to organized shift in many of the consumption names has not yet started, or maybe have started, but it's very, very anemic and very slow. And full test of the shift from unorganized to organized would only be gauged from the third quarter number onwards, because the base effect, positive base effect, will wane out over the next 2 quarters. So last quarter we actually saw price elasticity on demand on many of the consumption names. This is actually going to continue even in first quarter 2019. So positive base effect would mean the usual sectors which have delivered in the fourth quarter should just keep the momentum going. And as we begin financial year 2019, I mean, consensus estimates are that the Sensex earnings growth would be anywhere between 25 and 30%. Whether markets are wanting to discount that, I would believe that probably if 30% earnings growth comes, then these multiples will actually get re-rated.
Manish, but how soon before the weakness in the broader markets catches up with the benchmark indexes as well? Because this isolation, I'm guessing, is not going to remain for too long.
My sense is the mid and the small cap, the carnage that we are seeing is going to bottom out within a week or so. There's too much of excesses getting created on the downside. Of course, the risk management or risk mitigation exercise by the regulators is most welcome, but a lot of froth in the mid and the small caps is already out. People have just withdrawn from the entire space. And we have seen that whenever there is a shift away from the weaker hands into the stronger hands, the smart people would be liking to buy at these levels, that would create a bottom in the middle. So excesses create bottoms and tops in markets, and today clearly the excesses are on the downside. I would believe that this bottom can happen very soon.
More of the same, Manish, the Titans, Britannias and iShares of the world, or are there newer pockets that you're looking at as well after this weakness?
No, so I was referring to the mid and the small cap space. On the contrary, these large marquee names, of course, they are very good stocks, but the amount of up move that we have seen in many of these consumer staples is in a sweet spot. And if these prices, the levers, the Britannias of the world or the Nestlés of the world were to continue higher, it will just be on a given estimate of earnings, you would be building in a P re-rating. And can you really build in a P re-rating way beyond what is warranted? Again, you would have excesses created in the large cap space, which would warrant that even though fundamentals are very good, you are priced in for the near term more than what is warranted. So my sense is whenever there is sanity or semblance of sanity in the markets, you will see reversion to mean on both sides. You will see actually the large caps actually pull back whatever is seen re-rating over the last 1-2 months, and that they will tend to correct, and the correction that you've seen in the mid and small caps will again tend to correct on the upside.
So to put it simply, Manish, what have been your recent purchases? What are you buying? Kya le rahe ho?
So it's not fair to actually discuss specific stocks, but they would be broadly, our portfolio has really not changed too much, but we want to buy a few of the marquee names in the organized retailing space. We think that is a very exciting space going into the next 5-10 years at least, because there is a threshold per capita income beyond which organized retail really starts to see a J effect. So we want to buy some of these names in the quantity that we want to buy, but it's difficult to get whatever we want to buy. But that is one space which is looking very exciting, and more on the consumption space where So the travel industry, or let's say the luggage segment, etc. These are names which we want to buy at current levels. The numbers for most of these categories have actually been very positive from a fourth quarter number perspective, and we think that as we progress into FY19, again, build up on the earnings would continue for most of them, and P multiples are not that outrageous given the growth that we are seeing on many of these names. So from the next 2, 3, 5 year perspective, we want to lap them up when the market is seeing some severe correction.
So Manish, we also get a sense that redemptions have started in some of the mid-cap portfolio management schemes. And last year we were in a situation where 80% of the market went higher, 20% of the market was low or was flat. That was not because of earnings, that was largely because of a lot of liquidity was chasing limited stocks. Now the cycle has reversed. Do you think that this could be a problem, that PMS schemes could see redemption and that will create more pressure in some of these haloed mid-cap stocks?
No, so there's nothing called haloed mid-cap stocks in the current market environment. Everything is falling. Good, bad, ugly, everything is falling. Maybe good and great are falling less, and bad and ugly are falling much more. So that's how the situation is. But you're right, over the last 2 years, post demonetization, post GST, lot of money came into the markets and they went primarily to the mid and the small cap space. So there were excesses that were built. Now, I would put it like this, that yes, there have been redemptions, but gross inflows are keeping up pace. So, it's again a shift away from weaker hands to stronger hands. Those investors who have actually seen these sort of markets would very well know, and in fact they are gauging it like this, that it is actually the weaker hands which throw in the towel which creates the bottom in the market. So smart investors are not worried that much, but those who are jittery would press redemptions. There are redemptions, there is no doubt about that, but gross inflows are equally strong. So if we talk about domestic liquidity, they remain pretty strong. But is there a churn happening away from mid and small caps into large caps? That is also happening. So if let's say we were getting 100 rupees by way of net inflows in the month of, let's say, April, May was something like a 50% of that. So net inflows from 100 rupees has come down to 50 rupees. But still the flows are net positive. It's not that we are having net redemptions in spite of the markets actually taking corrections. But the whole point is that there has been a lot of inquiries as to whether these are the good times to buy into mid and small caps. So the retail HNI investor has actually become very, very mature. So gone are those days when people used to panic left, right and center and throw in the towel, maybe exit at the bottom. I don't think that is the situation. It is all about financial literacy that has actually percolated into a financial market. People are quite smart, and smart investors are actually looking to build up portfolios in current times as opposed to throwing in the towel.
Right. Interesting market timing. Manish, great to get in your perspective on how to approach this market, which really is on a crossroads in that sense. Good to speak with you as always, Manish.